This superyacht wasn't seized because of a crime. It was seized because of a pattern. No arrests were made. No trial was scheduled. No criminal charges were filed against anyone connected to the vessel. But U.S. authorities moved anyway. The yacht was worth over $120 million. It was professionally managed. It maintained legitimate insurance policies, crew contracts, and port arrangements. On paper, everything appeared compliant. And yet, control was transferred to U.S. enforcement. This wasn't a freeze that immobilized the yacht temporarily. This was a seizure, a legal transfer of custody from private ownership to government authority. It happened quietly. No dramatic confrontations. No countdowns. Just legal orders served through established channels. But the implications were not quiet. Because this seizure represented something larger than one yacht. It reflected a fundamental shift in how sanctions are enforced, not through individuals alone, but through the infrastructure of wealth that surrounds them. Modern sanctions enforcement doesn't wait for proof of wrongdoing. It doesn't require criminal conviction. It operates on a different standard, linkage. And once that linkage is established, distance no longer protects assets. Layered ownership no longer guarantees invisibility. Luxury itself becomes traceable evidence. This yacht became a target not because of what it did, but because of who reportedly controlled it, and how that control was exercised across borders, financial systems, and legal structures. This is how a superyacht becomes a sanctions enforcement case. Please like and subscribe to this channel. Sanctions used to be symbolic. A name added to a list. A bank account frozen. A public statement issued. The goal was visibility and condemnation, not operational disruption. But over the last decade, that approach fundamentally changed. Authorities realized that targeting individuals through financial restrictions alone wasn't sufficient. Money could be moved. Accounts could be restructured under different names. Legal entities could be dissolved and reformed. Physical assets, however, couldn't disappear. And among those assets, superyachts became a strategic priority, not because they symbolize wealth, but because they require constant cooperation from the global system to function. A superyacht cannot operate in isolation. It needs insurance policies, crew salaries, port access, fuel contracts, maintenance schedules, spare parts, technical support. Every single one of those dependencies creates a point of leverage. And leverage is what modern sanctions enforcement is built on. As international sanctions escalated, U.S. authorities began reassessing not just individuals, but the infrastructure surrounding them. That included banks, service providers, shell companies, and increasingly high-value mobile assets like yachts and private jets. The shift was deliberate. Authorities recognized that luxury assets are not just expensive, they're logistically vulnerable. They can't function without Western financial systems, maritime infrastructure, and legal compliance networks. That vulnerability became the foundation of a new enforcement strategy. Instead of chasing individuals through complex financial structures, authorities began targeting the assets themselves, immobilizing them, investigating their ownership networks, and using their operational costs as financial pressure. This yacht entered that enforcement environment during a broader review of luxury assets reportedly linked to Russian elite networks affected by sanctions. It wasn't flagged because of a single transaction or event. It was flagged because of a pattern, one that suggested the yacht's formal ownership structure did not reflect who ultimately controlled and benefited from it. And in the post-escalation sanctions environment, patterns like that are enough. The vessel itself was extraordinary. It was over 350 feet long. It required a full-time crew of more than 50. Its estimated value exceeded $120 million, placing it among the rarest superyachts in global operation. But what made it a target wasn't its size or luxury. It was its visibility. Because yachts at this scale cannot move quietly. Every docking creates records. Every refueling transaction leaves a trail. Every crew contract, insurance policy, and maintenance invoice becomes part of a documented operational history. And that history can be traced. On paper, the yacht appeared compliant. It was registered to a foreign corporate entity based in a jurisdiction commonly used in maritime law. It was managed by a professional yacht services firm. It carried insurance through recognized providers. To casual observers, nothing seemed irregular. To investigators, it was a familiar structure. Because yachts at this value level are rarely owned directly by individuals. Instead, they're held through corporate entities designed to provide privacy, limit liability, and optimize tax treatment. This is standard industry practice. It's legal. It's common. But sanctions enforcement doesn't stop at legal structures. Authorities examine who funds the yacht's operation, who approves its movements, who has access to it, who benefits from its use. Those questions can't be answered through registration documents alone. They require financial tracing, service contract analysis, and coordination with allied enforcement agencies. In this case, investigators reportedly identified patterns that raised concerns. Financial support for the yacht's operation appeared to originate from entities connected to sanctioned networks. Decision-making authority over the yacht's movements suggested influence beyond its listed owner. The ownership structure mirrored arrangements seen in other enforcement actions. Individually, none of these factors proved wrongdoing. Together, they created sufficient basis for further action. Please like and subscribe to this channel. Superyachts are almost never owned by the people who use them. Instead, they're held through layered corporate structures that span multiple jurisdictions. A typical arrangement might look like this. The yacht is registered to a single-purpose company in the Marshall Islands. That company is owned by a holding entity in the British Virgin Islands. That entity is controlled by a trust in Jersey. The trust is managed by nominee directors who have no personal connection to the beneficial owner. On paper, the ownership trail ends at corporate entities and legal representatives. But sanctions enforcement doesn't accept that endpoint, because ownership and control are not the same thing. Ownership is a legal designation, whose name appears on documents. Control is operational reality, who makes decisions, who funds operations, who benefits from use. And under sanctions law, control matters more than ownership. Investigators look beyond registration to examine who pays for the yacht's ongoing maintenance and operations, who approves major decisions about the vessel's movements, who has access to the yacht and under what circumstances, who ultimately benefits from the yacht's availability. These patterns aren't always documented in public registries, but they leave traces. A wire transfer from a specific account, a contract signed by a particular legal representative, a crew member hired through a connected firm. Travel patterns that align with a specific individual's known movements. Individually, these might mean nothing. Collectively, they build a case for linkage. In this instance, authorities reportedly identified repeated financial and operational connections between the yacht and an individual within a sanctioned network. The funding for the yacht's upkeep appeared to flow from accounts tied to that individual. Key operational decisions were reportedly made by advisors connected to that individual. The vessel's availability patterns aligned with that individual's activities. None of this constituted legal proof of ownership. But under sanctions enforcement, proof of ownership isn't required. What matters is effective control and beneficial interest. If an individual can direct an asset's use, fund its operations, or benefit from its availability, then that asset can be treated as if it belongs to them for enforcement purposes. This is the legal framework that allowed authorities to move from investigation to action. Not because the yacht was registered incorrectly, but because the evidence suggested it functioned as if it belonged to someone within a sanctioned network. And that was legally sufficient. The yacht was not American flagged. It was not registered in the United States. It was not formally owned by any U.S. entity. But U.S. authorities still had grounds to act. Because jurisdiction in sanctions enforcement doesn't require territorial ownership. Can be established through transactions conducted in U.S. dollars. Use of U.S.-based financial institutions. Engagement with American insurers or service providers. Cooperation with allied ports and governments. Once any of those connections exist, U.S. authorities can move under sanctions law. And they don't need to file criminal charges to do it. This distinction is critical to understand. Sanctions enforcement is administrative and financial, not criminal prosecution. It operates under different legal standards. It doesn't require proof beyond a reasonable doubt. It doesn't require arrests, indictments, or trials. It requires evidence of linkage and a jurisdictional basis for action. In this case, both were reportedly present. The yacht had conducted transactions in U.S. dollars. It had used American-based service providers. It had docked in ports where U.S. financial infrastructure was involved. That gave U.S. authorities the legal foundation to act. The enforcement action itself was executed quietly. There was no public countdown. No dramatic boarding. No media spectacle. Instead, authorities coordinated with the jurisdiction where the yacht was docked and issued seizure orders through established legal channels. Unlike a freeze, which immobilizes an asset temporarily, a seizure transfers control. The yacht was no longer under the authority of its registered owner. It was now under U.S. government custody, pending further legal proceedings. This escalation from monitoring to seizure reflected a strategic decision. Authorities determined that allowing the yacht to remain mobile posed too great a risk. It could be relocated beyond reach. It could be transferred to different entities. It could become significantly harder to enforce against. The timing mattered. The yacht was accessible. It was within cooperative jurisdiction. It was already under scrutiny. That made decisive action possible. And when the seizure was executed, it sent a clear signal. Layered ownership structures no longer guarantee protection. Once a yacht is seized, its status fundamentally changes. It is no longer a private asset. It is evidence. It is leverage. It is a statement. The immediate legal effects are straightforward. The yacht cannot be moved. It cannot be sold. It cannot be transferred to another entity. All operational decisions are now subject to government oversight. But the financial effects are more complex. Because a seized yacht still costs money. Crew salaries must be paid, or crew must be released, which reduces the yacht's operational readiness. Port fees continue to accumulate. Maintenance schedules must be followed to preserve the asset's value. Insurance must be maintained or the yacht becomes a liability. All of these costs now fall under government authority. And that creates sustained financial pressure on any network that might still be connected to the yacht. If the beneficial owner wants the yacht back, they must engage with the enforcement process. That means disclosing information. That means legal challenges. That means exposure. If they choose not to engage, the yacht remains in custody, and its value slowly deteriorates through time and neglect. Either outcome serves the enforcement objective. Because the goal isn't just to take one yacht. The goal is to disrupt the infrastructure of wealth that sustains sanctioned networks. Every yacht seized sends a message to other asset holders. Structure alone no longer protects you. Distance no longer guarantees invisibility. Luxury itself has become traceable evidence. This seizure was not about one vessel. It reflected a broader enforcement trend, one that targets not just individuals, but the systems that preserve their wealth. Bank accounts can be restructured. Legal entities can be dissolved. But physical assets like yachts are harder to hide. They require cooperation from global systems. They leave operational trails. They depend on Western financial infrastructure. And that dependence is now being used as leverage. For U.S. authorities, seizing a superyacht demonstrates enforcement credibility. It shows that sanctions have teeth, not just symbolic ones but operational ones. It signals to allied governments that enforcement coordination works. And it signals to sanctioned networks that wealth alone cannot insulate them from consequences. In modern sanctions enforcement, luxury is not protection. It's exposure. And this yacht is one example of how that exposure is being used, not loudly, not dramatically, but effectively. Please subscribe to this channel if you haven't. See you in our next video.